Good morning, it's 10:29 a.m. Eastern Time, Tuesday, October 29th. This is the real estate portion of the report. This is Richard Posson. Let's begin with a long-term outlook of the Dow Jones REIT Index. Okay, the symbol I'm using is a $ REI, and we can see long-term 3-year cycle top back in 2007 when real estate peaked ahead of the peak for the economy in 2008, and of course the financial crisis and crash, and we can see it coming down into a 3-year cycle bottom. Now it rallied into a 3-year cycle top and was supposed to come down into a 3-year cycle bottom. That would have been normal. But with all the QE business, the bailouts, the lingering recovery, the market actually became bullish and then said, oops, I got to come down into a 3-year cycle bottom, brought it back down. And you can see the price was lower than that top. It's almost as if at the last minute they made that down move after all. And they wiped out most, if not all, of this rally. Then they said, oops, we got to get back within this uptrend. But it was a new uptrend, a different angle, if you will, and extended longer and on up into a 3-year cycle top this year. Then they drop it into a 3-year cycle bottom. Now, it's still rather early. It is possible. The real estate just bounced here recently, and it's back down by the end of this year to early next year for a 3-year cycle bottom. And then it'll just rally on into for some of 2014. In fact, it should even be higher priced by 2015. That's when the next 3-year cycle top should occur. So this is a little bit different than the stock market, because we're saying the stock market is up into early 2014, but it can correct late 2014. We can even have a 3-year cycle bear market, and then it should be higher 2015 on into 2016. Whereas this REIT index, which really is it behaves somewhere between the stock market and real estate market, actually, because it is a stock version of real estate. It is a stock market. At any rate, however, the best forecast is this index can actually rally all the way into 2015. So a bit of a debate here, just what 2014 would be. I think it's telling us, even though we might have a few bearish moments next year for the stock market, that probably the stock market is going to be up for 2015 as well. At any rate, long-term indicators trying to roll long here. We've called a long-term bottom in place. We say regardless if it's up in 2015 or not, your release ought to be bullish somewhat into 2014. Now that implies that the real estate market itself ought to do well, but I must admit at times this particular index can reflect also how well the stock market's doing or otherwise. Okay, now let's roll out to or zoom in with use of the weekly chart for this index. And we can see we've had the L1 cycles we're always talking about in all the other markets, and the trend is up, and it's probably up into next year, okay? Up into January. Now, that breaks down into L2 cycles. I'm tracing them out now for tops, and it's time to rally into an L2 top, probably due in November. And we think late November to be in line with the stock market that may not top until Thanksgiving to even the beginning of December. Now, by December, there will be an L2 bottom, and it can pull back a bit. And I'm a little suspicious the bottom even occurs ahead of this top, and it may even occur back here with the fiscal event, the possible crisis, the government shutdown, that it was an early bottom. It just simply didn't work and does not matter, and therefore this L2 top may not cause any kind of a correction whatsoever. It may not work. It may not matter. I think it's safer to say, look, yes, they can sell a little bit in December, but that may be too late for an L2 bottom, and that may only be an L3 short-term bottom, just a little dip. It may not matter. Best assume higher price into early next year. Okay, now from the NAREIT site, okay, which has the FTSE NAREIT index, we're now looking at something that's not stock market's version of real estate. It is the paper version of real estate, but it's closer to real estate. These are REIT indexes. You can buy partnerships, buy into various funds that aren't necessarily traded on the stock exchange, okay? And it's just another way of investing. And my guess is it can come in line with more of what the real estate market's actually doing. Well, what do we have here? This is a yearly bar chart of the NAREIT FTSE Real Estate Index. And what we can see is back in the 1972, it topped for a 9-year cycle. It came into a 9-year cycle bottom in 1974, and we all know commodities were exploding higher into 1974. There was an inflation scare. The stock market was dropping hard and fast. It was a crash or mini crash. Okay, economy was in trouble. But then real estate just went up anyways. Came into a very quiet bottom for a 9-year cycle. Really didn't work for the nature of the 9-year. It basically just kind of rested. Then it went on up into a 9-year top. And I've come to the conclusion, real estate prefers the 18-year cycle and the 36 and probably 27, 72-year cycles better, or more so I should say, than, say, the 9-year. At any rate, it drops into a 9-year, but that was also an 18-year cycle. And look at that nice graphic portrayal of a cycle, upside down U or V pattern. Here's another one. This 9-year cycle worked fairly well, and it was a halfway point of the next 18-year cycle that worked extremely well for the bear market and extremely well for the bull market phase. What it was doing is exploding into 36 and 72-year cycle tops, similar tops, cyclical tops as that as the stock market, okay? Then it crashed into 36 and 72-year cycle bottoms alongside 18 and 9. Now in our model, we leave the 18 out. We just don't particularly care for it, but you can put it in, and I will discuss it, especially when it comes to some fundamental information and, say, real estate, but in the stock market itself and commodity markets, we don't particularly care for it. Okay, but it is, you can put it in there. Now, we've had a really nice bull market, but it hasn't gone to new record highs like the stock market itself. Okay, we've seen some 3-year cycle fluctuation. I'm tracing out one here, and there's another one in here. A little difficult to see them because it's running rather intense trends, and it has a history of running minimum variation intense trends. This 9-year cycle and 18-year cycle works very well, actually. Okay, not so much on the downside maybe for the 9-year, but certainly works well for the bull cycle. Our forecast from the high made in 2007 is that real estate will not top again for 36 and 72 plus 216-year cycles until the 2030s, no later than 2042. So we are super cycle bulls for real estate. But we're just saying the direction's up, and we think we got a general idea of timing. But we're not saying how well that the real estate market does. Maybe it doesn't do that well in the next 20 years. But the point is, it shouldn't do terrible. It shouldn't be an extreme underperformer compared to its own history. It should be a bull market. Okay. Now we break that down into 9-year cycles, and of course the 18-year would allow for a bull market maybe the next 10 to 20 years, fit inside that super cycle. The 9-year basically is in line with our macroeconomy forecast, our stock market forecast, our commodity forecast, that everything's going up until 2017 to 2019. We're not going to see a recession until after that top. And it'll take about 1 to 3 years to have that recession and clean things up a bit, and we should have a bear market in commodities and stocks. We should see a tick up in unemployment, but nothing massive. It will be a standard recession. It's not going to be a depression. It's not going to be a crash. It's not going to be an end of the world scenario. In addition, I want to warn you, notice that the real recession was right around 2000, 2001 here, yet notice that during that time, real estate was up. Now, you can make an argument, real estate had its recession in the late 1990s in a bear market, and then it actually rallied a bit, though, during the U.S. recession. That's fascinating, that it could have that strength. I could see it just moving sideways, maybe, but to actually rally in the face of a recession. I think people were basically saying, I'd rather take the money out of the stock market and put it in real estate. I'm not sure. That's just fascinating. So the point is, we might see the same case towards the end of this decade. It really does not come down much at all. But I just want to warn you, at the same time, you can have a bear market. You can see we had a bear market ahead of that recession. Maybe it was a leading indicator. We also know in 2007, real estate topped ahead of the actual recession for the U.S., the actual peak of the economy for the U.S. So it's possible real estate peaks a little sooner, a little ahead of the recession. Could still have a bear market, and a very worthy one, but I doubt it's going to be anything devastating. I think the bottom line is you just got to think, hey, real estate's going higher next 20 years. It can have hiccups and bumps along the way. At any rate, there's a good case made here by the model that we've seen a 3-year cycle top and a 3-year cycle bottom, just like we just showed you for the stock market's version of real estate, that REIT index for Dow Jones, that indeed it can place a 3-year cycle bottom now, and indeed it can rally all the way into 2015. And this is more for the cash REITs, which I think is closer to relation to what's really going on in real estate. Now, I couldn't find the Case-Shiller index for real estate, but I did see an update for this morning. As of August, there was a real nice spike up. In fact, I'm going to stop this now and go find that chart. Okay, I was having difficulty finding some of the previous sites that I can use for the Case-Shiller. This is at Barron's.com. It's put out by Econoday. It was updated today. And we can see this is the Case-Shiller 20-City Home Price Index. And we can see for August a nice spike higher, okay? In the percent change for the month, a strong month for August. Now, I wouldn't be a bit surprised. We're going to learn September may have slowed down a little bit, backed off a little bit. And it really wouldn't surprise me to see a dip in October. Some of the real estate reports recently, the monthly reports and a little faster, more frequent reports, are showing some slump. But I'm fine with that. September and October is kind of a flaky time of year. It's kind of like we were optimistic for summer and then we're kind of pessimistic come fall. But I think we normally become a little more optimistic by year end for the year end holidays, basically. And I just don't see anything here that would tell me we got any drastic kind of correction coming for real estate. I think everything's working well. You can also see this is the yearly performance year on year, and the real estate prices have just been moving up aggressively here from, say, 2011 on into 2013. Now, this kind of doesn't match up with what we're seeing for the REIT indexes, the cash, and the stock market's version of cash, but and except for this like monthly slowdown performance here. So I don't doubt we're going to see some slower performance. I think we've seen prices run ahead of themselves a little bit, run ahead of the marketplace and the economy. But I think in general we want to assume still a strong, firm real estate market. Corrections should be allowed, slowdowns should be allowed, but they're probably going to be short term. Basically, we're going to see this real estate market rally higher here in the next 3 or 4 years. Also, you want to look at the lumber market. That's looking strong. I'm long-term bullish lumber. That's a little hint of good demand from real estate. Now, I think our exports have picked up also around the world and with China and whatnot, so that can play in there as well. But we also take the lumber market and plug it in along with copper as an input for the model. And the model's basically saying, hey, be bullish to economies to later this decade. Everything's okay. We might have hiccups along the way. We're still going to have negative news almost daily, but we're going to see a greater sprinkling of more positive news almost daily from now in the next few years here. So bottom line is I am still long-term bullish real estate. You can either follow the trend for the next 20 years and buy real estate. You can follow the trend for the next 3, 4, 5, 6 years here to be bullish. And then you're going to have to be concerned towards the end of this decade of a little bit of recession and how to deal with that. And then you're investing on the paper side, especially the really liquid side where you can jump in and out. I would say you'd want to be buying the REIT indexes here and see what you can make out of it going into next year. You may even find you'll want to set on it into 2015. Thank you.